Hello and welcome to the Life by Design podcast, brought to you by Strategic. This podcast is all about helping you live your great life. Each episode will feature insights from our Chief Investment Officer, Doug Walters. Hello and welcome back to the Life by Design podcast. Doug is joining me again.
Here I am.
And today, we didn't do a weekly insights this past week, so we're just going to skip right into the topic at hand.
Yeah. Every once in a while, we need a week off.
Yeah, right. We do. Yeah, we give Doug some time off here and there so he can rest for the next weekly insight. And today's topic is risk.
That's right.
And so when we typically hear risk, especially kind of when it's in regards to finances or the market, where we generally think of the market fluctuations as kind of risk. But really, there are other areas that risk can also be associated with that we deal with on an almost daily basis.
Right. Yeah, it is so easy to talk about risk as volatility. That's what those ups and downs are called, volatility, because if you go back to your Finance 101 and you look at your portfolio construction equations, if you will, they're all built around volatility as the risk measure. But the truth is that is just one measure of risk and arguably not the best measure of risk for long-term investors.
All right. Well, then what is the best?
Well, let's put it this way.
Yeah.
Think about if you're a long-term investor, what you care about is getting from where you are today, point A, to some point B in the future, that, retirement goal, whatever it is. And you don't care too much about the path if you're not needing access to those funds. You just want to make sure that you get from A to B. So those ups and downs, those short-term moves just really don't impact you and shouldn't impact you. So this idea that volatility is a good measure of risk in finance doesn't really apply very well to like long-term investing.
Right, because in that regards, if I'm understanding this correctly, the risk is that number that I'm trying to get to. So whatever goal I set for myself to be, when I retire, I should have X dollars in my retirement savings, whatever vehicle gets you there, but I should have X dollars in my retirement savings. The risk is only if I don't reach that number,
right?
Not necessarily the path that got me to that number.
Right. And there's no formal financial term for that. Sometimes we call it mission failure, right? Or just failure to reach your goals. That is the ultimate risk for a long-term investor. If you don't reach your goal, that's obviously not a good thing. But what we can talk about is the risks in the meantime that might cause that, like what might cause you to miss that goal. And to me, those are the more important risks that we need to think about day by day.
Yeah. And I think one of them that we talk about a lot, and it really struck me, we had done last year, and we're doing it again this year, but we had done a retirement masterclass. And when I was building out the slide decks for the team and like we were getting ready, like one of the things that really struck me that I personally had never thought about before is that retirement number we just mentioned, right? That's what I need and that's all I'll need when I retire at 65. That's how much money I'll need. But the reality of that is that, like, if I can retire at 65, I may have another 30, 35 years past that. People are living longer and longer. So 95, 100 isn't unheard of anymore. And so, like, I also need money that's going to stay and keep my level of living where I want it to be during my retirement years.
Right. Yeah. So there's another risk, longevity risk. The idea that you might live too long, you might outlive your money. And so it's really important to plan in, a margin of safety to ensure that if you do live to be 100, that there are funds there to cover that. And the way I like to think about it, if it's a great way to think about it, like long-term planning, getting from A to B, is there's some rate of return on your investments, some performance measure that is going to get you from A to B. You're putting aside, $1,000 a month. You assume some rate of return. Let's say it's 7%. Is that going to get you where you need to give you that margin of safety in retirement? And that's sort of the starting point. And you kind of have to work backwards from there. If 7% isn't enough, then maybe you need to take more risk. So this brings us to another measure of risk, which is not taking enough risk. If you're too conservative, if you put all of your money in cash, you may not get there unless you have a really significant income coming in. But if you're relying on solid investment returns over the years, you're going to need those returns to be a certain amount, and that amount can be determined by that ultimate goal you're trying to achieve.
And this is, for us, and I assume but when you're asked as an investor or you're coming in for financial planning advice, what your risk tolerance is,
right?
That's what we're referring to as saying, hey, are you okay? Like, because we're going to have to, if you want to get to your goal, like, you're going to have to get a little riskier if you want to make that happen.
Right. So risk tolerance, when we're thinking about that, we want to understand the client, right? What is their risk tolerance? What we were just talking about was sort of like, what's their need to take risks? So you want to think about what's their tolerance for risk, but also how much risk do they need to take to get where they need to go? And you really have to, sort of balance both of those. That need part, though, is really important.
And so we're saying the word risk a lot.
Yeah.
A lot. And in that example, what are we talking about? Like, what does that word mean?
Right. And that is, again, we're sort of falling into this trap of talking about risk as volatility again.
Yeah.
So when we're talking about taking more or less risk in your portfolio, we're typically talking about the allocation to riskier assets like equities, which have a tendency to go up and down quite a bit, and bonds or treasuries that are a little bit more stable, income producing. So the more you have in the riskier assets, the more volatile assets, the riskier your allocation is. But also, the greater your expected return is if you're doing a good job in that allocation.
Yeah. Yeah, and so it's almost depending on you as the individual and where you're at in your retirement savings journey. It's gonna, you may have to take a risk if you have a certain number, or you sit down with one of our advisors and they tell you, hey, you need to be at this dollar amount by this age, and in order to get there, you may have to be riskier, and that's
right.
That's where that would come in.
Right. And I think this is probably a good point to pivot to those other risks. Yeah. So this is almost the easy part, right? We can say we can do a retirement forecast. We can project what does Jay's retirement look like X number of years from now, and we can plug in expected return based on this risk that we're taking, the mix of equities and bonds. In a way, that's the easy part. The journey along the way is where investors have the potential to introduce additional risks that they don't need to be taking. And those are, I would say, the more important risks to consider. And that's where we're talking about things like permanent loss of capital.
Yeah.
And so permanent loss of capital, think about it in the most simplest terms. If you own a stock, right? You own a company, an individual company, that company can go bankrupt. If it does, that the value of that stock is zero and it is never coming back. The value of your investment has been lost permanently. So when we think about investing that risky part of your portfolio, we want to make sure that we're going to avoid the best we can that permanent loss of capital. So we do that through diversification, making sure we're investing in a variety of companies. We want to avoid concentration risk, not having, all of our assets, maybe they're in a bunch of companies, but they're all in the same industry. That's concentration risk. Or even, the S&P 500 last year was, 20-30% of the assets of the index were in a handful of companies. That's concentration risk. So anytime you have concentration risk, you're increasing the probability of permanent loss of capital. The other thing we want to avoid are assets that just don't have any real financial backing, like cryptocurrency. We talk a lot about how cryptocurrency is not an investment. It's not an investable asset. It is really driven, its price is driven by demand, not, say, company earnings or some sort of financial backing. It's really just demand driven. If demand dries up, you're going to suffer permanent loss of capital.
Right. Yeah, it's really interesting. And also, it's funny, I was talking to one of our advisors here about, my kids, they're getting older and they're starting to like put money away and stuff like this. And one of the things we talked about is, maybe they should just put that money into an IRA, because then they can't touch it, right? And so there's your own personal risk of like seeing cash in the bank or something and going, okay, I could spend that and go buy that car. In my son's case, he wants to buy a car, but like, I could spend that money on a car. Or, the less sexy quote unquote option is for him to put it in his IRA now, so that he can't really touch it, so that it's in a retirement fund.
Yeah, and that kind of gets to behavioral risks, right? What you're trying to avoid is, bad behavior, bad financial behavior anyway, pulling money out that should be invested for the long term, or even the money in that IRA, making sure that you're not market timing, right? Getting nervous and take it out of equities, put it all into cash. That sort of behavior, again, can lead to another form of permanent loss of capital. If you try to market time and stocks rip and they go up 10%, guess what? You're not getting that back. You lost that opportunity.
And a little like warning to that for folks. I think a lot of times with the market timing stuff, we only hear about the positives.
Yeah.
So we only GameStop, Nvidia, like all these things. We hear about all the positives, right? And like, oh, I made X dollars and I did this and blah, 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 right? We don't hear about all the stories about all the people who either started late or tried to time it again and then actually lost a ton of money and then owe money at this point, right? And so, it's just as bad. It's the casino, right? Like, you could, you might be able to do it, but you probably won't.
Right.
So.
Right. Yeah. Market timing is really tough because you actually have to get it right twice. You have to get it right on the way in and on the way out.
Yeah.
And the chances of doing either with exceptional timing is really low. So if you're thinking about trying to beat the odds, trying to always tilt the balance in your favor, that's not a good strategy.
And so what other risks do we have?
So there's liquidity risk. We've been talking a lot in the last few weeks about alternative investments. So, private equity, you could tie up your money in funds if you happen to need that money for some reason. It's tied up, right? There's no liquidity there. You're not going to be able to sell those assets, or if you do, it's going to be at fire sale prices. Then we're talking about, permanent loss of capital again. So liquidity risk is a really important one. And I'd say the other important one to keep in mind, and we sort of touched on this with the mission failure, not quite getting where you need to go, which is inflation risk. Inflation is real. Even when it's low, it tends to be a positive number.
Ew.
And the implication of inflation is, let's say you were a very conservative investor and you just decided, I'm just going to stick all this money under my mattress.
Yeah.
And whatever I make, I'm just going to stick it under that mattress. Well, that's earning nothing. turning zero. And if inflation is 2 or 3%, your purchasing power is deteriorating. So you're actually losing money rather than saving money.
Right. Yeah.
So you need to at least be investing enough to cover inflation, and that just keeps you at break even. And then anything above that are actual real investment returns.
Yeah, I that's such an interesting thing because I think, generally speaking, not everybody. I'll just, I guess, point the arrow at me. But you think about, oh, I'll just put this. It's cash. It'll always be cash. Like it's $1. It'll always be $1. But that's not the point, right? It's
Right.
that whatever the value of that dollar was in the market at that time, can shift over time and be maybe less, and then that dollar's not worth as much as it was when you put it away.
Right.
Yeah, it's an interesting way to see it. Yeah.
Right.
Making sure you're keeping up with that.
Right. Yeah. So it is important to be saving, but it's also important to be earning a return on those savings. Otherwise, you're still working, you're still going backwards.
Yeah. And also understanding too, like a big thing that I've been learning about lately is also like, I think for some of us when we're younger, the thought of retirement is kind of this nebulous future self problem that I'm putting into my 401k. I'm doing the good boy things. But it's just so far in the future that it's very nebulous at times. And like one of the things we've been talking about lately is like, well, what level of like do you want to live at? Because that's going to determine like, do you plan on having the same bills or the same standard of life as you have today while you have a full-time job when you're retired? Because that's going to take X amount of money,
Right.
Or are you going to pull back and, hopefully you'll have a bunch of stuff paid off, like your house and, and all that, and you're just going to kind of be a little bit more relaxed. Well, then, that takes a little bit less money, but there's a lot of thought put into that, I think on a daily basis, when you're first putting into your 401k or opening that, whatever the vehicle may be, the IRA or whatever, you're not really like thinking that through.
Right. Yeah. It's really important to put it all together, think that through. I think the power of doing a retirement projection, being able to see what that looks like in numbers, what your life can look like down the road, and making sure you have enough to support that. And I would suggest, if your advisor has the ability, to ask them to put in, zero returns or just returns just equivalent to inflation, and see what that does to that number 20, 30 years down the road. You might be surprised how big of an impact it has. It's just so important. That risk of not earning a return over these earning, investing years is really high.
Yeah.
Yeah.
That's incredible. Any other risk that we should be looking out for, Doug?
I think those are the big ones. Yeah. That, the permanent loss of capital, behavioral, inflation risk, liquidity risk, all of these are, again, much more important than those day-to-day ups and downs. And I'll just leave you with this thought.
Yeah.
Okay.
Thanks.
Leave you with this thought. When you talk about volatility, if I measure the volatility of a stock, it can be very high for a company that is going up dramatically in share price day by day. So volatility doesn't think about up or down. It just thinks about movement. So, a company that is, if your portfolio is going up significantly day by day because of a few of these stocks, if it's up, it's not a bad thing, right? So up volatility is a bad thing. Down volatility, I suppose, is did I say that back?
Yeah.
Up is a good thing, and down is bad. So it's just, again, just to underline that point, volatility is not a good measure of risk. We kind of want upward volatility.
Yes. Well, and I it's worth repeating, and I know we've probably said it on almost every episode of this podcast, but and that's one of the things I think your team and you live by is we're not looking at the day to day, right? We're looking over a longer period of time, and we encourage, if you're listening to this, look over the longer period of time, because the day to day is going to drive you nuts.
Yeah.
And you want to look over a year, 5 years, 10 years, and then see where you're at, not what happened hour to hour today.
Right. And trust me, we will be watching the day to day, and we'll be taking advantage of those ups and downs. That's what we do. That's how we can add value, and you don't need to look at the day to day.
Right.
We've got that.
You worry about your end number. That's all that matters.
Exactly.
All right, Doug. Well, thank you so much.
All right. You're welcome, Jay.
This podcast is for educational and informational purposes only. Please see the full disclosure in our show notes for more information.